Hello and welcome to the forum. Every week, we take no more than 15 minutes to discuss the 3 highest conviction ideas surfaced across the Smartkarma network, cutting through the noise and helping you zero in on what truly matters most. The live forum and Q&A session are exclusively available to Smartkarma Plus subscribers. You can always revisit previous episodes on this YouTube channel. Without further ado, let's dive into this week's ideas.
Good evening and welcome to the Smartkarma weekly forum. For those of you who are joining us for the first time, the forum is a high-impact weekly live webinar exclusive for Smartkarma Plus subscribers. We use this weekly forum to discuss some of the best, highest conviction insights as surfaced across the network. Quick disclaimer, the forum is meant purely for informational purposes and does not constitute investment advice. It is the opinion not of Smartkarma, but that of our insight providers. And lastly, Chatham House rule applies. Please do not share any of this material without express permission on social media or any other public forum. Quick look at where we left it last week. We looked at PC Partners ahead of its results, which came last Friday. Profits grew nearly 10x, and it's trading on a close to 20% dividend yield as we speak. We also took a look at Rex International, which is Singapore's only pure play oil and gas company that has recently moved from the junior board to the main board and is trading on about 2 times PE and a high dividend yield as well. And we also started to pay a little bit more attention to an emerging thematic, which is how China is revising its policies and framework for dealing with COVID. So as you can tell, every week we try and look at 3 ideas. These could be small caps, large caps, or key themes that are trending across the network. In case you've missed prior forums, you can head on over to our YouTube channel called Smartkarma Plus Weekly Forum. You can view recordings of all forums, and you can also share these with friends who might be interested. What do we have in store today? We're kicking off with one of the Chinese mega caps, which is Alibaba. And we've discussed this before. We looked at the value opportunity in Baba. We also compared Alibaba to Tencent towards the end of last year. And today we will present a very, very simple, clean way of looking at the company. Second, we're going to examine Mapletree Commercial Trust. Again, this is a situation that we followed. It's been a 3-way activist tussle, and the activists are coming up on the winning side of this trade, and we love the asymmetry it has to offer. And lastly, we're going to explore another China-linked thematic today. There is a lot of policy change that's happening at the moment, and we're going to explore it in more detail on what the implications would be. A quick reminder before I commence. You can ask questions at any time using the Q&A button. The forum is generally quite rapid fire, just 10 to 15 minutes. So please don't hesitate to be asking questions at any point of time. Okay, let's kick off with Alibaba. You'll notice that we have referred to its Hong Kong listing here, 9988 Hong Kong. We've discussed previously how the Hong Kong listing will eventually overtake the US ADR listing, which is Baba US, and that started to happen. More and more volume is going through Asian hours. So the insight that we're going to explore more today has been written by William Milan. William Milan used to work with AllianceBernstein. He's been on the buy side as well before, and he likes to break things down to the raw core insight, and we like that. So today he's doing the same thing with Baba. So again, everyone probably knows Alibaba, but just in case you don't, it's one of the larger e-commerce internet plays in China. They have expanded beyond e-commerce, and they offer financial services and other internet content services as well. This is a dominant franchise. It's not the only e-commerce franchise, but it's the dominant franchise. And its retail platforms user base has grown at a 10% plus rate since 2019. What's very important is they're maintaining this growth rate despite a very high base already. Increasingly, the focus of the company is shifting beyond just the urban cities and more towards rural China. They're doing that by leveraging the Taobao platform and expanding it into Taobao deals. They've also built a community marketplace business. So I guess the key takeaway here is Baba is not sitting static. They are constantly innovating and expanding into the right areas where they continue to get growth. Now, there was rightfully a steep down cycle for Baba that began nearly 18 months ago, maybe even longer, slightly 20 months ago. And a very easy way to track that is by looking at the downgrades that analysts are having to do in their forecasts. Now, this downgrade cycle is starting to moderate now. In fact, we're starting to see it plateau, maybe even begin some early signs of it starting to turn. The other very interesting thing is there has been a lot of regulatory uncertainty with Baba, but the fact that Baba is now embarking on bigger and better buybacks is signaling to us and to other investors that they have a higher degree of confidence that the regulatory down cycle too is starting to end. Now, Baba right now is trading at just under 13 times PE. On average, it's traded close to 26 times. So this is a 50% discount to its own history. If you look at the core e-commerce business as well, that's trading at a deep discount. Of course, we have to be very mindful of the fact that there is going to be increasing and probably sustained regulatory scrutiny and oversight over the internet franchises in China. But where Baba trades today, those risks seem adequately forecasted and built into analyst estimates. So in such a situation, it does not take too much in the form of good news to really move share prices. And that's what's quite exciting about Baba at the moment. The stock has already started to move off of extremely oversold levels as well. So we would be looking at pullbacks to continue to add to the positions here. Okay, moving on to the next idea for today. We're looking at Mapletree Commercial Trust, MCTSP. This is one of the larger cap REITs, real estate infrastructure trusts in Singapore. The particular insight that we are discussing here has been written by Travis Lundy, who tends to focus on special situations. And as you can see from the small green circles on this chart, which you can also find on our platform when you go under MCT, Travis has been writing prolifically on this particular situation over the last 2 to 3 months. So let's take a look at what's going on. So as I mentioned, MCT is a Singapore-focused REIT. More recently, MCT announced that they are going to merge. They're going to absorb MNACT, which is another REIT. As they do that, their mandate will expand. It'll become a bigger, diversified business with a much larger scale than before. As a result of the merger ratio and this particular deal, MCT's share price has been really beaten down versus rivals. And what Travis has explored through this insight are the two scenarios. Either the deal goes forward or the deal breaks. In either situation, if the deal does go forward, then there is substantial accretion to MCT. And he also argues that it will lead to the creation of a top 10 REIT in Asia, and that will in turn lead to a very large index inclusion event. And when stocks get included into large indices and become so big, passive funds that track the index are forced to buy the stock. As such, you will see significant passive buying for that enlarged Mapletree REIT if this deal goes forward. And if this deal breaks, then MCT has really been beaten down versus rivals and should rebound as well. So for those who like to put on market neutral trades, like large hedge funds, they will be probably putting on MCT relative to its peers, so a long and a short position. But the asymmetry is compelling enough that one can look to own it outright as well. And, REITs have been underperformers of late because of rising interest rates. But, just to give you some context, 25 basis point rate hikes are now already built into the market estimates. So a significant amount of that interest rate upcycle is now well in the price. With that, I'm going to move on to the third and final item for discussion today. This talks about economic policy in China. The particular analyst looking at this is Nigel Chiang. And this is, one of the most important thematics for Asia and certainly for China at the moment. So before I get into this, I want to mention that this dovetails very nicely with our discussion on China's revised COVID policy. And that's what we discussed in last week's forum. And you can refer back to the recording in case you missed it. So today we're talking about slightly different policies. We're talking about much broader economic policies. So I think the real catalyst here, or the thing that we paid quite a lot of attention to, was the Vice Premier meeting that was held recently, where Vice Premier Liu He echoed what has been said recently, that China is going to undertake a U-turn in its policies, and they're going to be much more pro-growth. What does that mean? It means monetary policy will shift towards easing to support the economy. They will be avoiding any policies that have a negative impact on market confidence. This includes policies like, more regulatory scrutiny on certain sectors. They've also signaled strong government support for the overseas listed Chinese companies. Now, this is quite important because there was quite a lot of uncertainty around some of the US listings of Chinese companies, for instance, and it looks like China at the government level is now starting to intervene and reshore confidence there. Strong language was used in this meeting, forceful and effective measures in double quotes in a timely manner to prevent and mitigate risks in the property sector. This is something we've discussed as early as December with the audience. China really needs to stabilize its economy this year. That's the main buzzword. And there can be no stability without managing the transition of the property sector. So I think, again, we should start to see abating risks. That does not mean you go ahead and buy, low quality China property companies, but it certainly means that the broader economic risk from that sector will be cauterized. And lastly, this is not a long-term policy change. It is much more medium-term or even shorter term. They want to reshore confidence. They want to stabilize the markets. They want to arrest sales. And we feel that more medium to long-term, some of the restrictions and tighter policies around sectors such as properties will remain. But for the very short term, it means you have a good policy backstop to markets, and that's always good. With that, I'm at the end of the presentation part. If you have any burning questions, now's the time to ask. I've got a question coming in, which is today's webinar going to be available on YouTube? Yes, it will be, but with a bit of a lag, with a few days lag. We want to make sure that subscribers are given the opportunity to listen to key ideas firsthand and ask questions. But of course, if you miss the forum, you can come back to it a few days later and look at the recording. If there are no more questions, I'm gonna say goodbye and look forward to speaking to you next week. Thank you. Bye-bye.
That's it for this week. You can find more ideas like the ones we discussed today on demand on our YouTube channel. Remember to subscribe and hit the notification button. If you like these ideas, spread the word. Tell a fellow investor about Smartkarma Plus and follow us on social media. Just search for Smartkarma. And of course, don't forget to visit smartkarma.com for more independent, differentiated investment insights. Thanks for watching and see you next week.